Now that we've explained the basics behind negative gearing, let's talk about it in more detail. From a tax point of view, there are some areas that I'd like to highlight that can really make a difference to the bottom line. What I'll focus on is how to make your rental property as tax effective as possible. Before we go into the tax effectiveness side of things, it's worthwhile highlighting the fact that there's no point in getting into an investment property just for the tax perks. Your principal objective should always be to make money, whether it be due to rental income exceeding expenses, potential capital gains, or a combination of both. Setting the property up as tax effective as possible is very important, but not as important as making sure that you pick the most suitable property for you, the one that's most likely to increase your overall wealth. Let's look at the key features associated with tax effective rental properties. Firstly, let's address income. The property must have good rent prospects. In order to claim expenses such as rates and interest, etc., the property must either be being built for rental property purposes, or must be available for rent, or is currently being rented. If the property is available for rent, then you are entitled to claim all the expenses associated with the rental property. Obviously, if there's little or no rent coming in and you're incurring all the costs, your loss will be substantial. Although incurring a huge loss may be good from a tax point of view, it doesn't make much sense, as despite the fact that the tax office will give you tax relief in the form of a tax refund or credit, you will still be out of pocket. In order to illustrate how negative gearing works, let's work through the following example. Taxpayer A has purchased a new apartment for $400,000. The rent is $350 per week and it was tenanted for 48 weeks of the year. The property was vacant for 4 weeks of the year while the owner was trying to find a tenant. Total rent for the financial year equals $16,800. Now let's look at the expenses. The first expense is the real estate agent commission of 6%. This amount is $1,008. Even though any taxpayer could manage the property themselves, taxpayer A decided to go through a real estate agent. In order to effectively structure the property as tax effectively as possible, it does make sense to borrow to fund the purchase of the investment property. The more borrowings you have against the rental property, the better it is from a tax point of view. So the bigger the mortgage associated with the property, the bigger the tax deduction and the bigger the refund. A word of caution here though, the amount borrowed must relate to the property and can't be for any other purposes. Because taxpayer A has another property, she used the other property as security, and as a result, the bank lent her 100% of the value of this rental property. The bank lent taxpayer A $400,000 at 7%, which equals $28,000 in interest. Note how we only claim the interest component and we're not interested with her repayments. Taxpayers may have a loan where they repay principal and interest repayments, or just interest-only repayments. The interest is what's tax deductible, and often an interest-only loan is the way to go with a rental property, especially if you have other non-tax deductible debt, say against your home loan, for example. Always remember that you do not get a tax deduction for any repayments of principal. So in order to correctly structure the property from a tax point of view, borrow 100% of the property and pay interest only on the loan. This represents maximum tax effectiveness tip number 1. Finance the full purchase price of the property. Other tax deductible expenses include rates, body corporate fees, repairs, insurance and travel expenses. For this example, these expenses are as follows. We have the real estate agent fees, which were $1,008, and the bank interest, which was $28,000. These other costs include rates for $1,000, body corporate fees $2,000, repairs $500, insurance $750, travel $200, and other of $250. Total expenses now equal $33,708 for this property. In addition to these expenses, the taxpayer is also entitled to claim depreciation and capital works deductions, or capital allowances. Depreciation was briefly covered in a previous topic, and I suggest you revisit that topic. However, in short, an investment property has fixtures, fittings and construction expenses that decline in value over their effective lives. So when a newly built investment property is purchased, the purchaser will ordinarily receive a depreciation schedule for tax purposes that outlines how much these assets decline in value each year. For a newly built investment apartment, it's not uncommon for this deduction to be several $1,000s each year. This represents our second maximum tax effectiveness tip. Tip number 2. Properties that are either new or in top condition provide maximum tax effectiveness in comparison with older properties in poor condition. These capital works and depreciation assets are very tax effective because the taxpayer doesn't spend any money for this depreciation expense. Instead, this non-cash expense, called depreciation, which relates to both capital works and fixtures and fittings, simply increases the overall expenses against the rental property income and drives up the net loss, which in turn drives up the potential tax refund. Now, fixtures and fittings decline in value or depreciate at a faster rate than capital works expenses do. Fixtures and fittings include things like air conditioners, blinds, carpets, stoves, dishwashers, range hoods, and hot water systems. Expenditure that relates to capital works, on the other hand, or construction of the building expenses are usually big sums of money and includes things such as the building itself, a garage, a driveway, the walls and fences, piping, vents, ramps, windows, baths, cabling, retaining walls, and all sorts of assets. These particular assets have a longer lifespan than fixtures and fittings. The depreciation rate for capital works assets is quite low, whereas fixtures and fittings depreciate at a much faster rate. Now, it would be reasonable to expect a newly built apartment worth, say, $400,000 to have depreciation deductions of many thousands of dollars. The actual depreciation schedule can be prepared by a qualified valuer, and the report should be retained with the taxpayer's records. In tax terms, these types of deductions are often referred to as capital works deductions, or depreciation, or capital allowances, or even Division 40 and Division 43 expenses. In any case, for this example, we will say that these deductions are depreciation, or Division 40, deduction equals $6,000, and for capital works deductions, or Division 43 expenses, the deduction is $4,000. And the total of these two is $10,000. Now let's look at the full rental property schedule. We have rental income of $16,800, management fees of $1,008, bank interest of $28,000, rates of $1,000, body corporate fees of $2,000, repairs of $500, insurance of $750, travel $200 and other expenses $250. And our two depreciation amounts equal $6,000 and $4,000. That's another $10,000 in tax deductions, and the total expenses are now $43,708, which results in an overall net tax loss of minus $26,908. Notice how the non-cash expenses of depreciation have inflated the total expenses considerably and increased the net loss substantially. This loss is transferred over to the taxpayer's individual tax return and acts as a tax deduction against other income. You could look at this loss as a tax deduction of $26,908. Depending on the taxpayer's individual tax rates, the taxpayer will receive a direct tax credit based on this loss. Let's have a look at the individual tax tables again. If the taxpayer was on the 30% tax rate, she would receive a tax credit or tax savings of $26,908 multiplied by 30%, which equals $8,969 as a direct tax refund. If the taxpayer was on the 15% tax rate, she would receive a tax credit of $26,908 times 15%, which equals $4,036. This would be the tax refund. However, we're going to say that the taxpayer is on the highest marginal tax rate of 45%, and as such, she will receive $26,908 multiplied by her tax rate of 45%. She will get back as a tax credit or refund an amount of $12,109. Put another way, in addition to the taxpayer's normal tax refund, she would receive $12,109 based solely on this rental property loss. This represents another maximum tax effectiveness tip. Tip number 3. The higher your taxable income, the higher your tax rate and the higher the tax refund due to any rental property loss. In scenarios where the taxpayer is on the highest tax rate, the tax office tips in 45 cents in the dollar or 45% for every dollar that's lost. Now, let's look at the true cost of the rental property in our example. The rental income was $16,800, less all the management fees, bank interest, rates, body corporate fees, repairs, insurance, travel, other deductions and depreciation expenses resulted in total expenses of $43,708. The net loss was $26,908. The tax refund based on a taxpayer that earns over the top tax threshold of $180,000 is 45%. $26,908 multiplied by 45% equals a tax refund of $12,109. If we look at it all a bit closer, so the rent was $16,800 and the tax refund was based on all tax deductible expenses, which was $12,109. This means the total incomings were $28,909. You may have noticed that the actual cash expenses is only $33,708. This is because the $10,000 in depreciation related expenses was a non-cash expense and they were put in the rental property schedule due to the decline in value of the assets that formed part of the overall property purchase. The true cash expenses that affected the taxpayer's hip pocket were $33,708, as the $10,000 in the depreciation is only taken into account for tax purposes. The difference between the total incomings of the tax refund being $12,109 and the rent being $16,800, totalling $28,909, less the true cash expenses of $33,708, gives us a true net loss, not a tax loss, of $4,799. This is $90 odd per week. This looks much more respectable, doesn't it? So, taking into account that the taxpayer correctly structured the loan so that the full amount was borrowed and she paid interest only, she combined this with a healthy depreciation schedule, and the taxpayer was on the top tax bracket, it resulted in maximum tax effectiveness for this rental property for the taxpayer. And careful planning your tax affairs is very important, as if any one of these tax effectiveness tips was not at its true maximum, a rental property such as this one used in our example would cost a lot more than $90 per week for this particular taxpayer. It's not unrealistic that a $400,000 property could cost a taxpayer, with different circumstances, several hundreds of dollars per week, which can be disastrous for the taxpayer. We have some useful rental property worksheets and checklists on our website, and I encourage you to look at all of them. Also, your financial affairs should be looked into thoroughly before you commit to any investment, especially geared investments, and I urge you to discuss your specific circumstances with your advisor, or if you're a gold member of our hotline, contact us.